Welcome to the weekly update, where I'll go over the action in the market for the week of October 7th through the 11th, and then we'll see how things look for the week of October 14th through the 18th. So we had another up week. Really, the market is kind of defying what we're seeing. We have some very interesting VIX signals, and if you want to learn more about that, please watch the daily video updates. We've been watching those. We've also had a period of weak seasonality and additionally a Hindenburg Omen. Now, all of those things tend to be negative together, but it hasn't seemed to play out at all in the market right now. We were going sideways. Then on Thursday and Friday, we were able to break out to the upside and set a new all-time high with the S&P. But we want to be aware of these things anyway, because they could come into play at any time. A few notes to go through before I get started. The daily video is where I do the main basis of my analysis and commentary. So I know people are busy. I know people have longer term perspectives with the market. But if you want to view those from time to time, I do post them on YouTube and Rumble. There's a PDF that's available in the description below every video that I post. I also update pivot points every day on the YouTube community tab. They last for the whole month on one chart, and they're updated and they only apply to that day for the other chart. So there's two charts that I post there. I do have a private Facebook group. You're welcome to join that. It's not really active. If you like the videos, if you like what I do, but you don't really want to become a member, the Facebook group is another way that you can interact with me if you belong to Facebook. I do really watch YouTube and Rumble comments. I delete all the social media expert comments, the people that say they watch my video and how great they are, but they're really not watching them. So I actually worked up an email that I'm sending back to them. And of course, they're like not interested in working with me in the way that I want to work with them. I do post on Rumble as well as YouTube. Sometimes I'll have some uploading problems. Here is the link to the YouTube channel or the Rumble channel. Also, I have a thing that I talked about just a second ago, the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. There's a link that will take you to the website. There's also a link about a video that you can learn more about the program. If you are a member, you get immediate access to the videos as soon as they are uploaded and ready for viewing. You can send me an email if you have any questions about the program. And as I mentioned earlier, I do a lot of weekly videos, but they all tie into the daily video. So if you really are at the point where you're trying to make some decisions and you're a longer term investor, you just don't see the need in watching the video every day, they're still available to you that you can view on an as needed basis. All right, let's go back and talk about this week's session. We were up 1.11% on below average volume. That is a concern. Now, that's a basic tenet of technical analysis when we're going up with the S&P and we're going down with volume. But we've seen that before, and it hasn't really led to anything too significant. But we still want to be aware of that because sometimes it does give us a clue that there's less conviction as we're going up because volume is dropping off. We are positive when we look at all of our charts, and I'll show you that. We did get a reading on inflation with CPI and PPI coming out this week. They were taken as friendly. And so the Fed still looks to be on track to cut interest rates at their next meeting and possibly the meeting after that. And we'll show you those charts. We want to keep an eye on what's happening geopolitically, specifically in Israel and between Iran and Israel. There's the whole Hamas and Israel thing. There's the Hezbollah and Israel thing. Israel's kind of taking care of those areas. And so now it's becoming more of a potential direct conflict between Iran and Israel itself. These are the holy days. We're going through the holidays in Israel right now. And so things are a little bit calmer, but they could pick up at any time. Mainly, we watch this to see what kind of an impact will it have on the markets. And we really keep an eye on oil. We are still with a weakening trend right now, but it's positive. The green line is above the red line, and I will show you that chart. So just some bullet points to go through here. The S&P and Dow set record highs after a very choppy week. We've been going sideways now for quite a while. And then, as I said, on Thursday and Friday, we were able to break to the upside there. And then we have a lot of geopolitical worries. There's, of course, Hurricane Helene. There's Hurricane Milton. That's causing a lot of people to focus on different things. But the economic reports and Fed policy was taken as positive. The Fed did release their meetings. There were really no surprises in it at all. In fact, that's the next bullet point here. So the market really didn't react to that all that much. The big banks, they really started off earnings season. They came out on Friday with JP Morgan, Wells Fargo, BlackRock. I guess they're included in this group now. They were all taken as positive after their earnings results came out. And that's what really helped to push the market higher on Friday anyway. Interest rates are back up. We're going above 4% with the 10-year yield. Doesn't seem to mean that much to the stock market right now, but if interest rates do keep going back up, that may come into play. And the dollar index, even though it's in a longer term downtrend, has been bouncing ever since it came down to that 100 level. Okay, and so for the week, the Dow was up 1.2%, and I have to turn on my pointer here. The Nasdaq was up 1.1%, as was the S&P, and the small caps were up 1%. And a lot of that was really seen in Thursday and Friday session, with a lot of that coming on Friday. This is a chart that I've been showing for about a year and a half, just to give us a bigger picture look at what could potentially happen with inflation. We're still in this blue area where inflation is coming down. Well, what we want to watch for is a real turn up in inflation and see something like we saw in the mid to late 70s. And that was really difficult for the stock market. It may play out different. We may end up continuing to fall, or we may go sideways and things may become more stable. But we just want to be aware of this, realizing that the way things are right now does not necessarily mean they're going to stay that way. And then we're back above 4% with the 10-year yield. So that could be biting into corporate profits. According to Renmac, when we get above 4.02%, that's when it starts to have an impact on the earnings per share. Okay, this was updated a week ago, so it hasn't been updated now. We are seeing a pickup in those folks that are being unemployed starting on their 7th month. And one of the reasons that I wait to do this video on the weekend is for these charts to actually update, the Isabel Net blog charts. The takeaway from this is we see the red arrow, which I put on here, going up and to the right. That just means that earnings are looking positive going forward, and that ends up being positive for the market. Then, and I'm going to include this for a few days in the daily video, TGI Thursday and Friday, they have been the most positive days so far in 2024. Then household aggregate financial assets with about 16% in debt, 15% in cash, and about 48% in stocks. And that's typically what we've seen, even though this is a pretty high level. Because the market's been going up, people have been getting more into stocks. If we turn and start to go into a downtrend, you'll see this line really start to fall. And we're seeing a lot of money flowing into China. Now, China's having a lot of difficult times economically, and so the government recently has been announcing some stimulus measures and cutting rates and making money more available there. And so we're seeing an awful lot of money. We're getting folks that are trying to get in on the ground floor, the bottom of the market, anticipating that it will go up. Just like we're seeing a lot of money right now coming out of Japan right now, even though the Japanese market has been holding up fairly well lately. And then this is a breakdown. I showed this a few days ago in the daily video. These are just the different components that make up the core CPI, which we had the reading of that on Thursday, and just the different areas that make up the core CPI. And that's the inflation gauge that the market really follows. And then the GDP upgrades to spur asset allocation to China. This is just different projections that they're looking at. Because the government has announced a lot of stimulus and a lot of things to try to get the economy going again, there's a lot of wonder that, okay, are things going to actually look better going forward in China? Market implied U.S. recession probability still kind of high, but a lot lower than it was just recently, that we're more likely to not go into a recession. Now, there are other charts you can look at that say, yeah, we're going to go into a recession. We just have to watch this unfold and see the story as it develops without trying to front run this. Then FactSet, because we're coming into earnings season, they have a couple of different posts here. It says S&P Financial Sector's earnings preview. Now, this is this came out on the 7th, and they really reported on Friday. So this was before the banks ended up reporting. And it just has a breakdown of the different components of the financial sector. And then the earnings growth looking forward here as well. And then there's also saying that the S&P will likely report earnings growth above 7%. I think the average is around 4% or so. So that could be pretty positive for the market. When we see above average earnings, now they tend to lowball this going into the earnings report, so it looks better when it actually comes out. But that can really give a pop to the market and be positive. All right, here is the chart going back to Monday, where we did go higher. We were down a little bit on Monday, but we went higher in Tuesday session. And then we were just pretty much sideways for Wednesday and Thursday. And then we did go up a little bit here, and we had a positive close here on Thursday. But the real strength came, even though we had a flat open, we saw some upward movement here in Friday's session. And this has helped things to turn more positive and setting a new all-time high with the S&P. So when we look at the indexes, all of them are up for the 5 trading days that we just finished. Small caps up the least, with the NASDAQ 100 actually up the most. Then going back to the beginning of the year, we have the NASDAQ doing the best, followed by the S&P and then the NASDAQ 100. And small caps are still lagging behind, but all of the indexes are positive year to date. Looking at the sectors just for the week here, where the tech sector ended up being up the most, it was up 2.45%. And industrials, which that's more based on what the economy does, the financial sector, a lot of that came on Friday. Healthcare, which is more defensive. Materials, also more economically driven. Staples, which is more defensive. And then we had some other areas that were down this past week, like communication. We want that to go up if we're more positive on the S&P. Discretionary, it's been doing well compared to staples, but it hasn't been doing all that great lately, just when you look at it by itself. Then I do it a different way here, according to the scooter score on a scale of 0 to 100. Utilities still looking the strongest, even though they didn't have a great week. And then financials and the industrials. These are all in the 90s. So these are the strongest areas of the market. We're down at the bottom, we still have energy. And that's, again, I'm watching that more for geopolitical reasons right now. So looking at the 5 trading days, we had tech and financials and industrials were up on the week. All the other sectors ended up being down. Year to date, we still have utilities performing the best, with communication. That's a growth area, even though it didn't have a good week this past week. And the financials, and slightly positive, are the industrials. And again, I measure this a little bit different. First of all, it's a different way. I don't necessarily compare it to the S&P. I'm trying to look at more of a raw score here. Then we look at the relative rotation graph, where the stronger areas are up in the top right corner with the green. Now, utilities have been stronger, but see how they're really trailing off? Real estate has still been looking good over the last year. Financials doing okay. And then we have staples, which also been rolling over a little bit, and healthcare. These are more defensive areas. And then discretionary doing a little bit better here, but Tesla just got hammered on Friday, down almost 9%. And then we're seeing XLK. This is a big growth area. This is tech, and we want to see this doing better. And it's one of the weaker areas lately. And then XLE, which is energy, which has been under pressure lately. Here's where we look at it more in a spreadsheet format, with real estate, utilities, financials, industrials looking about the best, followed by consumer staples and healthcare. And then more the middle areas would be materials, discretionary, and communication. Negative areas would be energy and tech. So we want tech and communication to do better than what they've been doing lately. That's how the market really gets going to the upside. Then looking at different indexes, utilities were the strongest area, but now they're falling back. We have the Dow Jones Composite also rolling back, small caps rolling back. It's not seeing an awful lot of strength here. A little bit of an improvement with the S&P 100, the S&P 500, not much. The NASDAQ 100, this is where we buy low and sell high. It's one of the worst performing areas right now. Transports, a little bit better, but still not doing all that good. Mid caps also falling back recently. So not seeing a lot across the board strength, but we're not seeing necessarily a lot across the board weakness either. The areas that really drove the market higher, they're not necessarily declining. They're just kind of not going anywhere right now. They're just chopping. We have a few like what Meta and Netflix, their charts are looking pretty good, but we're almost getting ready to see a death cross with Microsoft if we see more weakness, and that could be pretty influential. Google is close to a death cross, and that's when the 50-day moving average goes below the 200-day moving average. So looking at it in spreadsheet form, we're still having utilities, even though they've been pulling back, looking pretty solid for the year. The Dow Jones Composite Average and the small caps, which have been a real disappointment. Transports, they've just been chopping around, as have mid caps, where the S&P 100 and S&P 500 had been stronger earlier on, but not showing as much strength now. And actually negative right now is the NASDAQ 100. Then looking at sentiment, really neutral right now with the latest reading from Investors Intelligence coming in at 2.35. We only get really excited if it drops below 1 or goes above 3, and we're just about in the middle now. And this is kind of interesting. For the first time since I've been following this site, I don't participate in this, but I follow it on a kind of regular basis. We actually have Donald Trump leading now. This is the betting site that I think is illegal in the US, but it's kind of interesting to watch this because people are actually putting money on this thing. And then we're getting close to that 75 level. Now, we could top out where we're at right now, but when we get up above 75, that's when we start to use sentiment as a contrarian indicator because the market is appearing to be too positive at that point. And here's a chart showing how we getting close to that 75 level, but we've been around here for a while. You can see earlier in the year, we can hang out around these levels for quite a while. So we'll just be watching that. We don't make decisions based on this. We just use it to confirm any weakness that we're seeing in other charts. The active asset managers starting to get a little bit extreme right now with their latest reading, a little bit more positive, but not necessarily really extreme positive. So they're coming in at 90.28 with the latest reading there. And this is where we're seeing some concerns. The VIX is still above 20, even though we're setting an all-time high with the S&P. We want the VIX to be down around 15, 14, 13, 12. It's still above 20. And that's causing some of the other charts that I look at to flash these warning signs that have been flashing for about a week, but the market really hasn't reacted to that very much. But we want to keep an eye on this because when we get above 20, this is where we see negative annualized returns for the S&P. We're still looking good here when we compare cash with tech. When the black line's going down, that means tech is outperforming. And folks are pretty positive right now when we look at the right X bear bull ratio. When this goes up, they're bearish. When this goes down, they're more bullish. Not really getting an extreme reading with the Ulcer Index right now. It's below its moving average. Not seeing any real concern here when we compare the spread between risky and not as risky bonds. And here's an inverted look at that. See, we're getting very high readings here, which means very low risk because this is an inverted chart. And the latest reading from the American Association of Individual Investors coming in with a positive reading, but not above 30, where it starts to get extreme positive. We look at the ratio between the VIX and the 3-month average of the VIX. This is starting to go up, which the VIX is going up, and that usually is more positive, or excuse me, negative for stocks, but we're setting all-time highs with the S&P. But we're still going down when we look at the 253 simple moving average of the equity put call ratio, which tends to be longer term positive. And still doing okay here with the financial conditions. We're still below the black line. The latest reading from GDP now coming in a little bit over 3%, where the consensus is about 2.5% to the upside and about 1.5% to the downside. Still, the takeaway from this is that we're looking positive for GDP. If we go negative with GDP, that's usually when we are in a recession. And then a week ago, this was updated. We're at 0.5 now. When we get above this red line, the red line's at 0.5. We went above it. And a lot of times when this kicks in, a recession will happen after that. We don't know. Even the creator of this says maybe this time it's different. But you got a lot of the perma bears out there just drooling right now, just totally certain that we're going to go into a recession. And we might, but we're just not seeing it yet. And then the smoothed U.S. recession probability, still getting a very low reading here. And here's another look at the recession probabilities. This is more of a blow up where we're above the black line, but we get concerned if we go above the red line. And the Bray Butters hasn't been updated. This is a quarterly chart. Inflation now did add another week where we had CPI come out and there was a little bit of an adjustment there, but inflation seems to be under control. So now the Fed is going to be meeting on November 7th. And as of Friday's close, the market is almost 90% certain that they're going to cut rates another 25 basis points at that meeting. And they're locking more into this because the blue area is right now, a day ago, a week ago, a month ago. So the general consensus, and this has pretty much been reiterated by Chairperson Powell, that they're looking at probably 25 basis point a cut at this meeting and possibly at the next meeting after that, which is what we're seeing more of here. That after the December 18th meeting is finished, we'll be at 4.25 to 4.5, which would be 25 basis points at the next meeting and then 25 basis points at this meeting. And the market's becoming more convinced of that right now. Looking at the Fed balance sheet, where this always amazes me here, going down with this line, but going up with the number, and then the year-over-year basis is going up, but the number's going down. That's can be understood. We watch this just to see if anything really weird is happening with the overnight reverse repurchase agreements, just in case anything weird is happening, but to this point, it doesn't look like there is. So looking at the advanced decline line based on price, this is a weekly chart, looking really good based on price and volume. We're also setting highs on the daily chart and seeing more new highs and pretty much no new lows right now. So we're still looking positive with the 4-week, but we're continuing to decline with the 10-week. And it's not that we're seeing an expansion of new lows, it's that we were trailing off with the new highs. Advanced decline ratio starting to get extreme when we look at the 19-week. That's the blue line, but this is still positive nonetheless. And our trend, this is what I'm talking about. It looks a little bit like spaghetti here. We're dropping below the moving average. That suggests a weakening trend, and we're coming down with the ADX. In a more positive or more strengthening trend environment, we would see the black line going up. But we are positive because the green line is above the red line, the green line's going up, and the red line's going down. The Erin indicator tries to measure the difference between buyers in green and sellers in red, getting quite a high reading here, and that could be considered extreme positive. And we're seeing a very similar reading right now on the daily charts. Mass index not generating a signal since we didn't go above the blue line. And then looking at a daily chart here where all you can say is we set a new all-time high on Friday, but you see how volume has just been trailing off as price has been going up. And that's a concern. That's kind of a technical analysis 101 observation that you learn, and we would like to see volume confirming the upward move in price. We're still positive across the board with the Keller market model on all time frames with all the indexes. Bonds are still negative in the short term. Commodities are negative in the long term. The dollar's been bouncing back up, so it's positive in the short term, but negative in the intermediate and long term. And we're still below this trend line here and above the midpoint. So we're looking good there longer term. And then we look at a 50-week moving average here, the red line, and prices above that, and both are going up. So that is quite positive. And we're above the moving average crossover here, above the 13-week and 50-week moving average. Prices above both, and all the lines are going up. Quite positive. Accumulation distribution, we might be getting a little far away from the moving average, but we're above an advancing moving average, and that is positive. This is a chart I've been showing in the daily videos. We're above this R2 pivot level on the weekly chart here and setting a new all-time high. And we're trying to cross barely back above the midpoint. We're slightly negative here with the McClellan oscillator. And we're seeing that same reading right now on the daily chart, where it's looking a little more negative. We're coming down after being extreme with the summation index based on price, but we're still looking positive even though we declined slightly with the volume. Bullish percent index, seeing the same thing on the daily chart, a very, very high reading. And if you go back and look at other times when we spiked up and then started to come down, quite often that meant a top or at least a slowdown for a while before we started going up. So we want to be aware of this happening. The Swenlin trading oscillator based on price crossed back above zero. It stayed above zero based on volume. That is positive. And we look at the momentum. It's chopping around a little bit right now. We're trying to turn back up with the PMO. The PMO based on price did decline. It actually advanced based on volume. And that's what we're seeing on the daily charts, where volume is outperforming price right now, which could be positive. But we have to ultimately follow price. The PMOs that are rising showed some improvement. We're still declining with the buy signals. We're coming down after just barely extreme positive with the PMOs that are above zero, which could also be taken as positive because these are PMOs. So there's 503 of them because those are all the stocks in the S&P, and the PMOs inside the S&P above zero is still getting a very high reading. We're not looking extreme, but looking positive here with the Bollinger Bands. We didn't close outside of the upper Bollinger Band. And we're a little bit concerned about what we're seeing on the daily charts with the Chaikin money flow, but this is still looking better. We actually went up with the histogram and the red line's going up, where we're declining on the daily chart. And here's momentum trying to go back up with the slope and the TSI. Those are the shorter term oscillators. The MACD is showing an improvement, as is the PMO and PPO. We're still negative, but trying to turn up with the long-term oscillators, the TRIX and KST. The force index is still positive and above zero. Chaikin oscillator going above the green line, showing good momentum. We're actually chopping more or less sideways on the daily chart right now. And almost getting extreme, but the money flow is above 50 and looking quite positive. The RSI above 50 and not extreme, so that's looking positive. Above zero since we had a positive week. And going back over the last 50 weeks, really showing some strength here. We were a little bit concerned when we were around this red line because sometimes it would top out at about that level, but now we're continuing to go up. And the Stochk RSI crossing above the midpoint, so that's turning positive there. Special K still negative, but getting ever so close to that moving average. Williams percent R is positive and looking extreme positive. And the ultimate oscillator turning back up and above 50, that's positive. And not really seeing an awful lot of strength here, but we're still positive with the vortex since the green line is above the red line, but we've been just kind of floundering sideways with both lines. The Copic curve, after being negative, is trying to turn back positive. So that's looking better there. And we stayed above all of these longer term moving averages and fib levels. So that really didn't come into play this week. We're looking positive on a weekly basis with the hike in ASHI. The Renko chart is positive with open blocks. The Kagi chart is black and pointing up. That's positive. And the three line break is positive. And we're looking pretty positive on the daily charts from a trend basis there. Not showing an awful lot of strength here, but we're above zero with the ease of movement indicator. And no new X's or O's were drawn. We're still working off of a triple top breakout that was generated on September 16th. And the momentum looking a little bit better in the long term, intermediate term, and even a bit of an improvement here in the short term. And watching the 50-day cycle, at some point I'll calculate when the next 50-day cycle will start. We'll see if that ends up mattering or not. Looking positive with the Elder's Impulse system for the S&P, and we're positive with the parabolic SAR. We had turned negative on the daily charts. Well, with the upward move on Thursday and then on Friday, we switched. Actually, I think it was Wednesday when we actually switched back to positive on the daily chart there. So looking at just the indexes, the S&P setting an all-time high, looking better here with the mid caps, but still not really breaking out above recent price. And the small caps are still pretty much just chopping sideways. The Dow is looking quite positive, as is the NASDAQ and the NASDAQ 100. And here's another look at the QQQs, the NASDAQ 100, but not back to an all-time high yet. The mid caps, they are now setting a new all-time high on a weekly basis here, but not really breaking out with any real conviction. Small caps still have a ways to go and have been spending a lot of time going sideways. Big software companies also looking positive. All stocks, which looks at U.S. stocks and international stocks, setting an all-time high. The FANG index not at an all-time high, but still looking positive. ARC in a downtrend and going sideways. The Wilshire setting an all-time high. This is a daily chart here, and that was set on Friday. The NYSE setting an all-time high this past week. The banks are looking pretty solid. On the weekly chart here, we're above 50 with the RSI. We're trying to turn back up with the momentum. And money's going into banks right now, which is just showing confidence. And September is actually kind of fooling everybody. I'm sorry, October to this point. September really kind of freaked a lot of people out because it ended up being not so bad. And so far, October's been looking pretty good. And then looking at traditional Dow theory, setting a new all-time high with the Dow, not even close with the transports. And we were showing a lot of strength with the utilities, but they've been pulling back lately as interest rates have been going back up. So looking at the CRB index, this is a weekly chart. where we're just barely seeing a death cross here. We're also in a downtrend on the daily chart, and a lot of this upward move has to do with energy bumping up. Oil is in the mid 70s right now. We're just keeping an eye on that. The dollar is still in a downtrend, but it really bounced off of 100 and has been going back up. Copper still looking like it's in an uptrend. That bodes well for the economy. Gold coming off of recent all-time highs here. Silver also looking pretty positive. And then we are pulling back with bonds based on price, but they're still in a longer-term uptrend. And a monthly chart shows that stocks are still outperforming bonds. This is a daily chart, how yields were really coming down, and now they're starting to go back up. But the stock market doesn't seem to care, at least to this point. They might start caring at some point, but not yet. Here's a weekly chart looking internationally. We see US and UK rates going up, followed by German rates as well as Japanese rates. And then some relative studies here, with gold still performing the best year to date, followed by stocks, and then oil and the dollar and bonds have gone back to being negative since the beginning of the year based on price. We look at some ratios. The NASDAQ 100 is still underperforming the S&P longer term. The S&P 100 doing a little bit better when compared to the rest of the S&P 500, but not really showing any decisive longer term strength now. We are seeing growth still outperforming value after it had been looking weaker. Gold is still outperforming stocks right now, but really kind of chopping around quite a bit. And gold is also outperforming the dollar, even though it's pulled back recently. Bonds continue to underperform stocks on the weekly chart. And we look at low volatility stocks, which are really underperforming the S&P. They were bouncing back up as folks were freaking out about the economy. Now this ratio is starting to come back down. Energy is underperforming tech, even though tech has been lagging itself lately. And discretionary is in a downtrend compared to staples, but it has been bouncing back up. And it's not so much strength in discretionary, although there's been some, but it's mainly weakness that we've been seeing in staples. We look at small caps to tech, showing how small caps, even with the big up move on Friday and having a positive week, they're still underperforming the tech sector. Then some long-term looks here, still looking really solid from October 2022. And here's the SWAG NYSE breadth thrust, nothing new to show there. And here is what the statistics are for the SWAG NYSE breadth thrust. Still looking good here above the trend line going back to the 1987 crash. Here's a further blow up of that same chart. Still looking quite positive. Still on a full-on buy signal with the NYSE Zohorchak method. And with the NASDAQ 100 still above this trend line as well. And the NASDAQ to Dow ratio still giving us a very high reading, not really showing any problems yet. And the Qs to small caps also showing a very high reading, not really collapsing as the perma bears thought it would. And I've been showing this a lot lately in the daily videos. Now we're above zero with the 50-day moving average of the new highs minus the new lows for the S&P. But we're starting to come down a little bit here. But you have to take almost a magnifying glass to see that. So we'll be keeping an eye on that. But it's still positive longer term. We look at that same thing, a 50-day moving average of the new highs, new lows for the NYSE, coming down a little bit, but still looking positive. And then we want to keep an eye on the 3-month yield because it really started to fall just like it did back in 2007. But so far, the context appears to be different. The reason this is coming down is not because the economy is falling apart. It's because the Fed is lowering rates and inflation is getting under control. That's why we pay attention to things to see if the context ends up changing. And then the cumulative new highs, new lows, showing a little bit of an improvement here. And the daily score for the NASDAQ, new highs, new lows, is still looking positive there. And then we have just an update. If you don't know what the Hindenburg-Ullman is, here's an explanation of it. But no updates since the last time I showed this in the video. We do have a confirmed Hindenburg-Ullman, but it doesn't, the market's not reacting to that at least yet. But this is what happened right before the COVID crash and right at the end of 2021. And this can take some time to play out. Seasonality. October tends to be positive 60% of the time with the average return of 1%. But we're supposed to be in this time of weak seasonality, but we're just not seeing that happen. Where this chart just shows the monthly returns since 1950 are positive in October. Also looking positive on a world basis in October. But when you look at it this way, with the presidential cycle, September, which was positive, and October, which often is negative, both of them are kind of performing the opposite of what they've historically done. And then we're in the first part of October, where it's the third best performing part of the year, where the second half goes on down the list a little bit. And then we do see some possible weakness here that we should have seen in September but didn't, and then possibly some weakness in October, according to Carson. And then comparing the NASDAQ and S&P, where we didn't really see any weakness in September, but we still might see some in October. But so far, the market's been bucking the historical trend. And then here, from August to October, typically sees negative returns during that period, but we've been holding up quite well. During an election year, October tends to be weak also. But the fourth quarter, when you take it all together, tends to be quite positive for stocks. And then the last chart, since 1950, we're up 9 out of 18 times, down 9 out of 18 times, with a return of 0.9% in October during an election year. So thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.